All right, we got Brian and Evan here from your Everyday Pro Investor team. So we're trying something new. This is a live video chat here. So we'll be throwing this up on the podcast as well, hopefully. But I want to try something new. Obviously, we're practicing our social distancing. We're not in the same area. We figured we would try this video chat, talk a little bit about the markets, what's been going on since our last podcast. So I believe, 2 weeks ago, Evan, was the last podcast?
Yeah, I think so.
So I want to say that after we recorded and put out the last podcast, that would have been right around the day that the market bottomed so far. I shouldn't say bottomed, but seems to have hit a near-term low on March 23rd. And with that, we actually had the fastest, I believe it was 30% sell-off since the Great Depression. And I mean, really, since then, we've gone back up over 20%. What's your opinion of this rally?
I think it's short-lived. I mean, it was a quick recovery. I think that, people are probably piling on thinking that the market did, in fact, bottom, and that was the worst of it. And everyone's just kind of on the expectations of the timelines that the government's providing on when the rest of the economy is or the whole economy is going to open back up. So I think everyone's just really anticipating that this thing passes and everything opens back up. I'm hearing like early summer by the end of May. But I think if there's any news that comes out that could be pushed at all, then I think the second, bear move down would be pretty harsh.
Yeah, I would definitely agree with that. I think that you're going to see potentially this week where the market's going to want to move lower because we're going to start earnings season now. We've had a few companies report, obviously, but we're going to get earnings season here. And I think that while everybody knows this quarter is going to be bad, you're going to have a lot of lacking guidance. And I think even some of the companies you might think would perform well, such as I think Johnson & Johnson reports Tuesday, right? They're in the medical space. They're a very big company, well diversified, definitely the best balance sheet in America. So we're not worried about them going out of business or anything, but I think their earnings are going to be hurt because they do a lot of medical devices and surgeries have been put on hold. Obviously, dentist offices are largely closed. I could see companies like that where people probably have pretty high expectations. If you look, J&J has ripped from they got down to 115, and I think they got up as high as 145-ish. I could see them pulling back, and I think that if they get down to maybe around the 125 or under level, it's another opportunity to add to that position. If you follow us, we're in that name, have been for a while. We've added to it. But if you're not in that name, I think anything below 125, it's a buy because long-term, this company is going to be there. They've got a great pipeline. They're obviously working on the vaccine for COVID. And I think that you could see names like that. I think Abbott reports as well that their earnings might disappoint. And I think that could shake the market up a little bit.
Yeah, definitely. That could definitely start we've been monitoring the market for the end of last week and even throughout the weekend. You and I, previous to this call, determined that we see a market pullback this week, trying to retest some of those levels. So on the last podcast, we talked about how we were looking for, just a handful of stocks that we believe are going to be fine and have a lot of upside once this all clears. So we went out and bought, super long dated calls. So at the end of the week, last week, when the market was, obviously rallying, what we did was we went and sold calls against those positions that were shorter dated to bring in premium, and then we actually turned around and used that premium to buy protection in the market, to buy puts on the market, so that if the market does in fact pull back this week, we're positioned really well, because we'll bring in more premium on the short positions through the options, and then also we'll be able to buy back all the calls we have sold against our positions for really cheap. And I just think that is right now probably the best way to to move around in this market.
Yeah, that's a good point there. I think that we look at a 50% retracement level. It's on the S&P 500. It's right around, I believe, 27.95. I'd have to check my math on that, but I believe that's where it was at. And if you look Friday, we closed right underneath that. We actually were through it. We got up to around 28.10, and then we pulled back and closed at 27.80 something. So just below that 27.95 level. I think that's pretty key there. I think that's the market telling you that this run up is probably running out of legs. You're going to see a pullback. I don't know if we're going to retest the lows. I could see, though, us pulling back. If you look at about 2,500 level on the S&P, if we can find some support in that area, I think we're good to go. And we probably don't retest the lows, at least not anytime soon. But if we don't find support at that level, I think you have a lot of downside potentially right back to the lows. And I think one way, which we talked about this a little bit before, Evan, but if you got a name you really like right now, you think we might get this pullback, figure out where that pullback range is that you're comfortable buying. Let's say we are going to retrace a little bit, maybe a 10% pullback. Look at the beta on your stock. If the beta is 1, it's going to match the market. It's going to pull back about 10%, right? If it's 1.5, then if the market pulls back 10, it'll probably pull back about 15. So find that level. And if you're willing and have the capital to buy 100 shares of that stock, go sell that put, relatively short data. We still have decent implied volatility right now in the near term. And you could sell that put, collect that premium, which will lower your entry point cost if you do get exercised. And then you get to buy a name at a level you like. If the stock never gets there, you've collected premium, you didn't put money to work at a level you weren't happy with, and you can reassess. I would keep those puts shorter dated, though, because obviously things are changing so rapidly that if this thing starts going to the other side, way up, you could always buy back that put at a lower cost, make some money on it, and then buy the stock. But I usually like to let those puts expire worthless if I sell them and I'm convicted in the name. I think that you keep it shorter dated in a few names you like. You really want to be a flight to quality right now. So good balance sheets, companies that are going to come out the other side of this things. You got your Microsofts. I like Blackstone. We talked about J&J. AbbVie's a name that we've liked for a while. We keep adding to that name. And then one we did add, I think this is the only thing we've added since the last podcast, was Raytheon Technologies, RTX. That name it's the combined name of Raytheon and United Technologies. That merger did close. This stock is trading at what I think is a really attractive level. There's some good synergies there. You've now created the second largest defense company in the world. I think that long term, this has got great potential. We got in the low 60s. We're looking for a pullback into the 50s to add to it. It's got like a 5% dividend yield roughly, and the dividend's really safe. So I think that's a good name to take a look at that you might want to potentially sell some puts against, or even just look for a pullback to get in on that name.
Yeah, and then we were also taking a look, or at least I was, in the cruise line industry because obviously they're shut down. So my thoughts were, let's look for the cruise lines that have the best balance sheets. So the one that I bought super long dated calls on was Norwegian Cruise Lines, and that that was 2 weeks ago, and then last week it rallied. So that's where I went and sold the calls against that position to bring down the cost. And if we get a pullback, if the market pulls back, I would imagine that would also pull back as well. So that's just one of those names where I have to figure out how much it would pull back relative to the market's pullback and figure out, do I want to buy the calls back, or do I want to, just figure out what I want to do. Do I want to pick up more positions on a company like that? I know in the airline space, I was looking at Alaskan Airlines because it's kind of the same thing where I'm looking at companies that have good balance sheets that might not need as much help from the government, which would turn into being more profitable than companies that have to take out some loans from the governments long term, just in terms of like profitability. So I think if you just looked at each industry and did some research on what companies are going to make it through this with the least amount of government assistance, that will turn into more profit, going forward compared to the companies that do have to take out loans.
Yeah, and you bring up two good industries there, right? Anything that's in like the travel and hospitality space is super high risk right now. But on a pullback, I like people entering into one or two of the higher quality names in those spaces, like you mentioned. Norwegian's a pretty good one. Carnival Cruise is getting a lot of institutional money attention. They were able to do a debt offering. They raised 2 billion, I believe it was. It was like 13.5%, but it was 2 billion. It shows that the markets are willing to provide capital to Carnival Cruise, probably to some of these other companies like Norwegian. You mentioned Alaskan Air. I like Delta, but again, these are all high risk, high reward. So you're not going to want to put a lot of money to work here. But let's say you do put in a small percentage of your portfolio, 1 to 2%. You could see these be 2-3 times returns in a year to 2 years if these companies are able to recover. And it depends on the trajectory of our economy, obviously, but I could see us getting back to where we were economically within about a year and a half, which sounds like a long time. In reality, it's not. I mean, we're talking about potentially -30, -40% year-over-year GDP change in Q2 here because we're shut down all of April. Going to be a slow startup in May. Hopefully, June you start to get some activity going. Relatively sound, but Q3 is going to be a struggle. I think Q4 you get close to normal, and then Q1 or Q2 next year, if things go right, you'll see that start to pick back up and get really close to where we're at now. And I think that's when these travel and leisure and the hospitality names can probably start to perform again. And I like that the strategy with the calls because you talk about implied volatility has such a large impact on the premium for options. Our near dated implied volatility is actually higher than the long dated implied volatility, which makes sense. There's a lot more going on now. The market's moving a lot faster. People are projecting out into the future that there's going to be less movement in stocks on a daily basis, right? So, like you were mentioning, Evan, you're buying the long dated stuff, which in real terms, it seems more expensive because they cost more than the shorter dated ones. But in options terms, let's call it, because the implied volatility is lower, you're actually spending less to have that time, and then you can sell those shorter dated ones, I guess. And there's a good chance by doing that, you're going to collect back most of your premium and really drive down your cost basis. And then when that option is worth 600-700% more, you've actually really returned like 1,000% because you've sold those shorter dated calls against it.
Yeah, exactly. That's in my opinion, that's probably the best way to make trades right now. Just because there's so much premium in the short dated volatilities, and like you said, the long dated premium, it's so cheap, relatively speaking. Like I'm buying calls that are 1 year, 2 years out for just a little bit more than what the short dated stuff's going for.
Yeah, exactly. It's really crazy, but this is the times that we're in. And even with the volatility pulling back a little bit, we're still seeing that implied volatility in the options is relatively high. So I think that kind of covers the market. Anything you want to talk about it related to COVID-19, Evan? I mean, I know here in the U.S. this was supposed to be peak week. Didn't seem to be nearly as bad as what the government had projected. Do you think that we get some positive news next week, or do you think that this thing kind of drags on a little bit longer than what the government's saying?
I'm not sure, even if it drags on a little bit longer, I do get the sense that the US is, I don't want to say like getting sick of this whole situation, but I think people can just are having a better understanding of what, the light at the end of the tunnel looks like, if you will. They're really just, at least for myself, like I'm just tired of this whole situation, and I'm ready for it to move on. I think a lot of people are, and the fear factor, like the panic, I feel like is not as great as it was, and I think people are starting to rationalize a little bit more.
Yeah, I 100% agree with that statement. The people I talk to are the same thing. They're getting tired of this. They understand that there's a real risk out there, and this COVID-19 is dangerous and it's new, and we don't have a great way to fight it right now. Obviously, we've got experimental things that we're trying, but People are really ready to be over this thing. And I'm hoping we get back slowly, start to get back here, come May 1st when a lot of states are planning to come back online. I'm really hoping that doesn't get dragged out any further.
The only other thing that we could mention was what happened with Luckin Coffee. I don't know. I think that happened after our previous podcast, but we did mention that because they were kind of extending their earnings and not being clear on when they were going to release that, we recommended to just stay away from this stock completely. And good thing we did, because they had a really interesting scenario play out with with their company, and obviously their stock was beat up because of the investigation and the potential fraud allegations. um, the stock's actually frozen right now. You can't even. So I was curious about that. So if you did short Luckin Coffee, how would you get out of like any positions that you have right now?
Yeah, right now you're stuck. Well, right now you're stuck. So you can't trade the stocks. You can't cover a short. You can't sell a long position. Options aren't doing anything. I don't know when the stock's going to come back online. Right now, the Nasdaq said until they provide adequate additional information, we're going to keep the stock halted. It's a crazy time. I mean, this is a Chinese company. There's always risk investing in Chinese companies. Obviously, last year we were big on this name. We really liked it. We made a lot of money in this name. We played it through options mainly. At one point, we did own the stock. All of 2020, we haven't really had any positions in this thing. The only position we really put on was a put, looking for them to go and pull back on the earnings, which never happened. And we, like you mentioned, we talked about it. We said they're not reporting. They keep delaying. Something seems strange. No, we did think that maybe once they reported, if they pulled back, maybe a potential buying opportunity. Obviously, they haven't reported. It's not a potential buying opportunity. The COO or CFO, one of the two, is basically like half their sales last year were basically fabricated, is what they're saying. So it's going to be interesting to see if this company even survives. I could see the Chinese government propping them up. I don't know that anybody here in America is going to have appetite to purchase their shares, and it's really going to hurt Chinese companies overall trading on, in the future that coming over. People just aren't going to trust it. And I don't blame people. This is the problem with Chinese companies and trading as an ADR. They don't have the same regulations that the U.S. companies do, the same oversight. So it was Muddy Waters, I believe, was the company that discovered the whole fraud. And they've been saying to people, this is what's going on. This is what's going on. And sure enough, Luckin started an internal investigation. And it turns out that, they claim, yep, we found it. I think they're just scapegoating people. I think every executive at the top knew. I mean, the CEO had a personal loan from Goldman Sachs that was collateralized by his shares. From what I understand, Goldman Sachs has now taken all of his shares, and they're going to be liquidating them on the market, whatever they can. As of right now, they can't even sell them. But I believe it was like $519 million worth of shares or more that they took from them.
Wow. Yeah, so I just wanted to touch on that real quick.
Yeah, no, that was key, and I'm glad you brought that up. And I think that covers everything for this week. So, like I said, first video here, giving it a shot, see what happens. If it goes well, maybe instead of just doing podcasts, we'll be doing these live videos and just giving our thoughts and insights out to our viewers there. So if this is your first time listening to us, watching us, go check out our website, everydayproinvestor.com, our member service there. And you can also follow us on Twitter, Instagram, and let's hope that we have a good week next week and some of the trades we have on go right.
Yeah, happy Easter and have a good week, everyone.